The commercial credit risk, it's been on the kind of a horizon or in a bullseye, so to speak, of all the regulators pretty much since COVID started, and you had this work from home and vacancies appearing. So I think the commercial credit risk, it's been at the top of the mind for all the regulators for we're going on 5 years now. There has been some rising delinquency in that in both the credit unions and the banking industry over the last couple of years. It's not what you would call a severe level of delinquency. It's still under 1%, but it has been going up. And I think that kind of catches everyone's highlights. We had the low interest rates during COVID. A lot of people refinanced their properties during that time at low rates, 2-3%. A lot of those are variable rate type loans. They're coming due for reset to the coming year. Of course, rates are up in that 6-7% range now. So some of these borrowers are looking at 300-400 basis points shot. And there's concerns, are they going to be able to pay? And, what's going to happen with future losses and delinquencies. So it's been the center of the bullseyes for all the regulators. We've seen it at NCUA. Some of our clients, they've been asked to stress test their commercial borrowers. They've been asked to stress test their ability to handle payment shocks. And I think we'll continue to see more of that. It's somewhat interesting when you read through that whole risk report from the OCC. They almost seem optimistic and surprised at how well banks are performing, but man, they are uncertain and totally worried about which direction things might go.
Great points. Steve or Dennis, anything you want to add on this topic?
Yeah, I think, commercial loans, it's a broad, right? It's a broad category. I mean, within commercial loans, there's different types of commercial loans. Obviously, I think what's getting the most press is obviously real estate values, particularly in like city center types of locations where, as Todd mentioned, the whole remote work, the high interest rates, right? There's a lot of vacancies occurring in those types of properties. Right? Just in the city of Minneapolis, for example, I think real estate values in the city center area, I think they're down since last year, almost 22-25%. So right, that's where the concern lies is in those types of commercial loans. And I know in our credit, our commercial loans were fairly small in nature, for the most part spread out, either residential types of multifamily dwellings. And those seem to be handling economic environment we're in pretty good. So I think where it gets challenging, not only for commercial loans, but also retail and consumer loans, is how do you forecast this, as Todd mentioned, what's your forecast for future? Because that all has to be somewhat incorporated now into CECL. So particularly as it relates to unemployment and real estate values. So it'll be interesting to see going forward with the current environment, what type of impact those CECL types of factors, how that comes into play. Based on what I've seen trending for both commercial, just overall loans, it appears that CECL, since was enacted in 2023, it's increased, but probably not at the same rate that we've seen delinquency and charge-offs increase. So I know there's different flavors of CECL out there. Not everyone treats CECL the same, but that could be a big impact, I think, to the credit union performance down the road.
You bring up an interesting point with CECL, Dennis, because you would expect provision expense to grow at about the same rate that loan portfolios are growing. And for the last couple of years, for the credit union industry, their provisions for loan losses grown much faster than their loan portfolios, much faster than delinquency. But for the first quarter here of 2025, CECL charges of provisioning actually shrank when you still have loan growth and rising delinquency. And it's like, you ask yourself, did they get ahead by overfunding in the past, or are they just getting behind because of earnings pressure? Like I said, just the way CECL works, you would expect provisioning to grow at about the same pace that loan growth is. And for the first quarter anyway of 2025, it's behind.
Yep. And it could be behind because they're trying to manage earnings a little bit. It could be a little bit of architecture of earnings there. So one other thing on commercial loans, not related necessarily to the risk report, but the things we've seen in our discussions with credit unions is NCUA being hyper focused on the annual review process that's required in the commercial loan portfolios. And oftentimes recently, some credit unions have not kept up with that. And that's something that definitely gets written up. And then the discussion about office buildings being empty and the return to the workplace and how that might reinvigorate some of these office spaces near where NCUA is at. Patent and Trade is right across the street from NCUA, and they used to rent 3 or 4 buildings in addition to the one that they own. And they've let leases go on 2 or 3. And then across the street from that, there's another agency that was renting the building right next to that, and their lease is up in a year, and it's been vacant for 4 years. And they have guards that walk around it just like the Patent and Trade offices. And they actually did a public notice that they're trying to convert that to either a condo or apartments. And then when you think about the rate situation that I think you both mentioned, and that's mentioned in the report, and there's a lot of those loans are structured with 5-year balloons where those can get repriced. So what happens when that happens if you can't reprice it? It reminds me of some or all of you may have gone to the School of Banking of the South for commercial lending class. Yep, I'm seeing some nods. There was a guy there, Professor Willie Stotts. He looked like Groucho Marx, and he coined the phrase, or first time I heard the phrase, a rolling loan gathers no loss. So you get to that, you get rewrite date, you want to rewrite to the new rates, which is why you put that in place. But can they do it? Can they not? You might see some pressure on delinquency in that regard. Steve, did you ever wanted to add on this topic before we move on?
Yeah, the commercial lenders, you're always dealing with kind of new issues that your borrowers are dealing with. Whenever I'm out talking with people who own businesses and stuff, the conversation anymore always goes to insurance. They are rarely being surprised. This is just in property and casualty insurance that they're being very surprised, and some of them are even being canceled by institutions they've been with for 20 some years. So I think that's kind of going to be a new problem. And then you look at, just the state of some of the flooding and that kind of stuff. Insurance is going to continue to be a new and more dramatic issue for a lot of your commercial borrowers.
Within the fine print of the report, they actually mentioned that rising insurance costs are increasing expenses for these folks. Just kind of turn this into credit unions too, and something we're seeing with some of our clients. As Dennis mentioned earlier, there's different types of commercial loans, but we're seeing NCUA is asking credit unions that are involved in the commercial lending business to really set concentrations on those different types of loans and different types of properties. Before it was a concentration limit on commercial loans. Now they want concentration limits on hotels, on office buildings, on just a variety, go through the whole NASIC codes and want concentration limits very detailed for the different types of commercial lending they're doing. So they're raising the bar on expectations for credit risk management for credit unions that are involved in commercial lending.
Great point. That's a nice pivot